Hi, this is James Eng with Full Capital, and in the May 2024 multifamily financing webinar, the theme this month is planting the seeds. And so this theme really comes from one of the largest owner operators on the planet in commercial real estate, Blackstone. And in their quarterly call, they said, "We are planting the seeds of future value in what we believe is a favorable time for deployment." And so this is one of the companies that we're going to be covering today on this May webinar in terms of earnings and what they are seeing out there in the market. And so in terms of the market and what we're seeing out there, we're going to go through sort of distressed deals on one side, extensions in the middle, and then stabilized deals and what we're seeing across multiple markets, and then also depending on the loan type, what type of deals we're seeing out there, and then really get into there's a bunch of earnings calls this month. We're going to focus really on owners, so people who own and operate properties, and then also lenders. And then third, we're going to wrap up with just sort of what we're seeing on the financing side and how deals are being put together on the structure. And so this deck is chock full of data, and so if you can't see it all or you're listening in the car, you can send an email to me at jeng at allcapitallending.com, and I can send you a copy of the deck. And then also, there's a lot of transaction data. I couldn't really show everything on these slides, and so if you're looking at a specific market and are looking for transaction data, whether that's distress or loan maturities, you can send me an email with that, and we can take a look at that as well, and run that search for you. All right, so let's start with distressed. I focus mostly in Texas, so on these deals, highlighted a couple. These were Arbor foreclosing on some deals in Houston. These two deals that are a little bit larger are deals in Fort Worth. So Argentic is based out of New York, and they foreclosed on two assets in East Fort Worth. And then Tides is facing foreclosure on three deals in Fort Worth, as they're having trouble raising additional capital and then modifying those loans. And so, from what I've heard, those have basically been to foreclosure steps a couple times, but they've seemed to have come up with the money each time. So, we'll have to wait and see this month and see if it actually goes through the foreclosure. But these two other ones in East Fort Worth, I think, are done, and they are now owned by the lender. In terms of other distressed deals that we're seeing, this deal in Austin was owned previously by GVA, which put on a lot of floating rate debt. And so it looks like they are just replacing the general partner on this deal. And so it looks like there wasn't new debt put on it on the acquisition, but a new borrower came in and assumed that bridge loan, which has a little bit more time. And then, once they get the occupancy up, maybe this shown occupancy of 60%. Once they get the occupancy up, maybe taking it to, Fannie and Freddie at that time. And so this was another deal that is out in East Texas, and it's already been foreclosed by the lender, and now is being offered below the debt amount. So we're seeing deals sort of in process, getting foreclosed, and then once it's being foreclosed, the lender is selling these assets at a discount, sometimes to the loan. Here's two other deals that I was about to record this, and then I got these two deals just in the last week, for people raising equity for deals now. And it looks like the momentum is picking up in terms of sellers being willing to go and buyers willing to step in. And so you see this deal. This is a deal in Houston that, even compared to 2018, it's at a discount to the pricing that the seller bought it in 2018. Qualifies for agency financing, probably close to 6%. And then this was a deal in DFW that, we had numerous people go after in 2021. The bridge loan amount was 37 million, or approximately 37 million. And then the new purchase price for the new buyer is right at 37 million. And so we're seeing deals essentially trade right at the loan amount or a little bit under the loan amount right now. But deals in the middle, I mean, these are deals that are not delinquent, right? So these are deals, whether it's Fannie Freddie, whether it's CMBS, there's really not that much delinquency, like, close to 1% only. Because a lot of the lenders, especially on the bridge side, as long as the borrower is willing to bring in additional money, whether it's interest reserves, interest rate caps, paying down the loan, their lenders have been extending those loans. And so there hasn't been much distress. And then Fannie and Freddie have been putting out, so far, I guess this year they put out about 25 billion, and they're trying to get to about 100 billion. I think they have capacity up to 140 billion. So I think they are below their target this year, and everyone's expecting them to be sort of in line with 2023, which is close to 100 billion. These deals in the middle, when you don't have an agency loan that's fixed, when you have floating rate, whether it's agency or whether it's bridge, these cap rates are getting quite expensive. It's usually about 3% of the loan amount. And, these guys are having a capital call right now in terms of having to raise additional capital for some larger deals. And so pretty much everyone who's on a floating rate bridge has had to do some sort of recapitalization on their deal. And so if you got distress, you've got deals in the middle who sort of need a recapitalization, then you just have straight stabilized deals. And Blackstone this is probably the biggest headline in the past 30 days, is that they've really gone on the offensive, and this is a $10 billion multifamily purchase. And these are deals that are not distressed. These are deals that are stabilized. These are low leverage deals, and these are on, top, Class A deals. So mostly coastal markets. And then, even here in Dallas, we're seeing deals that are stabilized, have numerous offers, have numerous tours, and there seems to be a healthy appetite for people coming in to buy, A minus, B plus deals that are stabilized, right around that sort of 5 to 6% cap rate. So once we get into some of the earnings calls, a lot of the earnings calls are from sort of Class A operators, but we're seeing, B deals still being heavily bid after right now. And this is probably the one thing that, everyone's sort of scratching their head about is, in Dallas or even nationally, I think this cap rate is a little bit, yeah, it's gone up a little bit, but there's not as many deals, maybe on average about 6%. But if you've got, a 4.5, 10-year, and you've got a cap rate of 5, it is very tight in terms of the spread between your average cap rate and 10-year treasury. Even tighter than back here. So that's what's got people scratching their head a little bit, is like, do we wait till rates come down, or are cap rates going to keep pushing up here? And this is what's really driving the divide between buyers and sellers on some of these deals where there's not a huge, tour count, huge offer count. But this is what everyone's been waiting for. At the beginning of the year, everybody was thinking, all right, federal funds is going to be 3.7, and then it was going to be 4.4, and then now this is sort of, after the Fed meeting, but before some of the readings on inflation, and we're baking in, maybe here's one cut and then maybe 2 cuts. So in between 1 or 2 cuts right now, by the end of the year, but it still puts you close to a 5% federal funds rate, either way you look at it. And so this is going a lot slower than most people anticipated. And so this is driving some transactions just in terms of the window for distress, but then also people who thought deals were going to be saved by a lower interest rate environment just hasn't materialized quite yet this year. So here we are with the 10-year. At the beginning of the year, you were right around 4%, and then it ran up to 4.75, and now it's trending back down to about 4.5. So, people are having to transact in this environment right now, which is definitely tricky. But spreads have come in, and so typically you add, let's say, 200 basis points, so that puts your rate at 650. But we're seeing spreads be in that 150 to 175 range, and so that's giving you a little bit of relief on the interest rate. So maybe you're 625 right now, all in at Fannie and Freddie. So let's start on the earnings calls with Blackstone. I mean, they are obviously one of the 100-pound gorilla in the space, and so their market view is, look, they're seeing inflation slow down. Borrowing spreads have tightened. They don't think the number of homes being built right now is the same as in 1960, even though we have twice the population, and they are not waiting. They're deploying capital right now, and they're seeing a decline in multifamily starts from the peak of about 50%. So, their mentality is, look, we're going after this right now. So they're going to start putting bets down. So here's a quote we started with the webinar. We're planting the seeds of future value and what we believe is a favorable time for deployment. And this is the time to go. And it's going to be a little bit longer. People were scared in the GFC to put out money, and they think this is the time to go. And one of the analysts asked, what about rate cuts? Don't you need to wait for rate cuts? And they were like, no, we're not waiting. They think you're going to get favorable pricing before everyone else jumps in, and so this is the time that they're going to deploy. And if the Fed takes longer, they don't care, because the more people that are waiting, then they're going to be able to buy more stuff. And so it might take a little bit longer before they sell these assets, but they think this period right now is the time to buy. And so they're buying now. And like we mentioned right now, earlier, the 10 billion of this Air Communities in their take private of the deal. And so we have a couple more REITs that were, in the multifamily space as well. And here's one that we haven't really talked about before, Avalon Bay. It's more of a Class A REIT. The demand is very high. They're thinking there's going to be pressure on rents from all this new supply, at least through 2025, if not 26. But this piece of it is what most people have not experienced, I think. I think in 06 and 07, it was pretty easy to qualify for a home mortgage and relatively cheap to move out and buy your own home. But what we're seeing right now is that only in Avalon Bay, we're seeing anywhere from like around 10% across these different REITs. But Avalon Bay had 7% move out to purchase a home versus they're typically 16 to 17. And so there's a 10% increase in the number of people who are staying in these communities versus moving to a home, just because it's 2 times more expensive. So people are looking at the math, and if you don't have the down payment, if you can't qualify for the loan, and just the overall cost, then you're not moving right now. And so, we're not seeing people move. But Avalon Bay right now is a net seller. And so I thought this was interesting because they put out 4 deals. They're all under contract right now. They're getting a cap rate of about 5.1. So I would say this is sort of your Class A plus deals. And from their perspective, they're taking advantage of the light volume right now. So they're not seeing a lot of deals on the market. So for the people who do have to transact, they feel like they're getting a scarcity premium, because if there's 30 bids on a deal and they don't win this deal, then 29 people ain't going to win the deal. So they're going to have to go out and buy another deal. So in reality, this deal should probably trade at 5.5. But because there isn't much on the market right now, they're able to get 5.1. So they put out 4 deals. They got those under contract. And I mean, they compared this volume. I mean, 23 was lighter than 22. In Q1 24 was even lighter. So, they're seeing deals, just the amount of transaction activity be pretty light out there. And in terms of overall market, the supply they're saying is staying elevated, and maybe it makes sense to start developing into this market a little bit later, where you're delivering in 26, 27. But right now they're focused on buying sort of stuff under replacement costs, a little bit older, lower price points, and lower density. And in Camden is more of a Sunbelt REIT operator. I think they have 50 or 60,000 units. Um, you know, they're saying this is 30-year highs for deliveries this year. So they're having to work through it. But in 2025, they're saying the starts are going to drop. And then, but the demand has been very strong. So what we're talking about, all right, do I buy a house or do I just stay in the apartment? There's still very strong demand, really because of this affordability compared to buying a house. So their new leases are down. So their new leases are 4.1% negative, but renewals are up, and their occupancy is 95%. So they've been focused on occupancy, so that in the spring leasing season, they're able to increase rental rates over the summer. So they've been focused more on occupancy. Camden has. So but they asked, well, are you guys buying anything right now? And, they reiterated that stuff is going for the low fives and it's negative levered. I mean, Fannie and Freddie, are six and a quarter. And, the bet is that once all the supply is gone, say for the next year, maybe 24, 25, then there's going to be rent spikes, 5 to 10%, hopefully in 26, 27, 28, if developers don't start going again. And so, they still think that, their markets compared to, let's say, California, which still hasn't recovered all the jobs that they lost during COVID, that, whether it's Dallas or Houston or Austin, I mean, they've added anywhere from 200 to 400,000 jobs in the last 3 or 4 years. And so that's what's driving the demand in the Sun Belt, and that's where they're going to keep investing. They are building some deals, and so they don't necessarily talk about how they finance these deals, but a lot of these guys, they have equity lines or just very large cash, to develop these deals. And a lot of them, they're developing. So this is what's interesting. They're developing to about a 6.5. So they're trying to get to their NOI divided by their development cost to about 6.5. And then as long as they are able to sell that same deal at a 5, then they're making money. So they're willing to do that deal and willing to trade that every time. And so that's what they're looking for. So they're going to start. They started two properties, one in North Carolina, one in Phoenix, and the lease ups that they have going right now, yeah, they have to do maybe 4 to 6 weeks of concessions, but they're able to get there onto that stabilized NOI yield. And yeah, new leases are down about 6%, but their renewals are growing about 5%. So, all right, some of the markets that are getting hit with supply, Austin, Jacksonville, are getting hit right now. But they think, look, it was really easy to get financing. It was really cheap in 21, 22. But going forward, it's going to be more normal supply environment out there. And so this was interesting in terms of, all right, so compare now to 2008. So MAA actually bought 9,000 units in 08 and 09. And, they asked them what was different this time, or what's different than right now. And they said real demand fell off considerably. So there's no one to lease the units to 08, 09 at any price, it seems like. And so this is what's different right now, is that the demand is still so strong because everybody has a job. Everybody has a little bit of money from COVID saved up. And so they just haven't seen that play out, and demand has stayed very strong. And then the other thing that they're seeing is that there's a ton of capital, right? So there's a lot of debt, a lot of equity ready to go. And so they're not seeing a lot of distress, and people are stepping into these deals across the Sun Belt right now. All right, so we covered owners. Now let's get into the lenders. And the lenders are, we're starting with Arbor. in terms of their loan modification. So, they said, this right now, second quarter is still peak stress. They're thinking it's going to be the rest of the year essentially, because if the rates are higher, this is going to just stress all these deals even more. They had to modify 1.9 billion of loans, so 40 loans, 1.9 billion, and every one of these deals they brought new money to the table, whether it's to buy rate caps, fund renovation, catching up these deals. And so on these deals, that essentially 45 million was brought to them to purchase new rate caps, and then about 1.1 they essentially had to cut the rate. So before they were paying 9%, but now they cut it to 7% all in. And basically, there's a current rate and there's an accrual rate. So they're going to have a 7% pay, but then also 2% is going to be accrued that you have to pay at the end. So this 3% of capital is really the cost of the interest rate cap. So if you buy a strike at 2%, you add, 3.5%, 4%, that gets you to about 6% interest rate. So that's what it's costing you to buy these caps. And the last thing they mentioned on some of these loan modifications is if these people did not have money to bring to a deal, they essentially brought in somebody else, and these other sponsors came in, took over the assets, and assumed the debt. So similar to that deal that we saw in Austin, where the general partners sort of switched out, and then a new sponsor come in to right the ship, and so sort of manage the deal and invest new capital. In terms of delinquency, so they said their delinquency was $1.2 billion, but now it's about 950. But they do anticipate more delinquencies coming. And in terms of CLO, so sometimes when they originate these bridge loans, they'll put them in a collateralized loan obligation. And in those, this was if there's an issue, then you essentially have to buy that loan out of that CLO. So they had to buy out about 223 million so far this year and sort of rework them. So one example was, this deal was 100 million. It was in the CLO, and they were going to probably foreclose on the deal, but they reworked it and got a new loan of 95 million, and then had the new sponsor put in 10 to 15 million in equity. So they're having to rework a lot of these distressed loans to get them performing right now. All right, so Walker & Dunlop is a agency lender as well, but they did not do really any bridge loans. So, in terms of market stats, they were saying that, Q4 was almost the lowest since second quarter of 20, which when there was COVID and really couldn't go outside. So that's how slow the market was in Q1. And then, Fannie and Freddie, they're expected to do the same as 24. And then in terms of this new reality, I think people are sort of waking up to that they're going to have to transact with these higher rates. So whether it's refinancing, selling, or purchasing, they're seeing a lot more people just go right now because the lower rates and cap rates weren't going to save anybody. So they're going to have to move right now. They only had 6 defaulted loans total, only 11 basis points of their sort of at-risk portfolio. And majority of their deals, the DSC is 2x of what they need. So not much of loan distress on their side. And they're asking, when do you think you're going to see a lot more people step up to the plate? In terms of 2023, a lot of people were waiting. They were thinking 24, they were going to see rate cuts, but it has not materialized. And they talked a lot about the Blackstone acquisition as well. And they called it a new cycle, beginning of a new cycle. There's a lot of equity, there's a lot of debt ready to go. And they feel like we're close to the bottom. So they don't know where the bottom is, but it's pretty close to the bottom right now. And then they're seeing a lot of drops in starts as well. But in terms of CLOs, this is really the time to get them recapitalized, and you're going to need fresh equity to come in. And then, they reiterated this point of, last time during the GFC, there wasn't equity and maybe there wasn't as much debt, but right now we're seeing both of those available right now. All right, so that was sort of an earnings recap. As you can see, the the themes across multiple players in the industry seeing similar things, not necessarily the same strategy across the board from all of them. But my background, I was born and raised in Houston, went to school at UT in Austin, and have been up here in DFW since 2006. I was an underwriter for G Capital sort of through the last GFC, and then have been focused more on the origination side since 2015 at Old Capital, and then investing in a number of properties across Texas since 2015. And sort of our focus is on the loan side. And so here's sort of your rates. I mean, obviously there's been some volatility on the 10-year treasury, but Fannie and Freddie are around 6.5 right now. Bridge is still, SOFR hasn't moved. Spreads are about the same. And then, your bank loans are about pretty much prime. So 8.5 plus or minus 50 to 100 basis points, depending on you as a borrower and your strength. So we're doing some bank loans right now. So this, I would say, under 5 million are still getting done. They're wanting you to bring deposits to the relationship. We've closed some deals with local banks recently that just whether because of occupancy or whether it's the tenant concentration that agencies couldn't do, you know, investors are doing bank loans in place of them, and then once they get stabilized, taking it to agency. On the Freddie Mac SPL side, I mean, their rates are probably a little bit higher right now than Fannie just because of the step down prepayment, but they're moving pretty quickly behind the movement of the 10-year treasury, and then once you sort of take the rate issue off the table, once you sign the loan app, so we're seeing. I would say these are 1 to 7.5 million loan amounts. So if it's qualifies now and you like the rate and you're getting a good cap rate, then a lot of people are doing sort of the Freddie SBL, even on refis right now, just to get some flexibility with the step down prepay. Freddie Mac conventional, I mean, these guys did most of the floating rate stuff on the agency side. And so a lot of people are refinancing out of floating into fixed to get rid of the escrows and potentially selling their cap to regain some of that liquidity at the property level. And then Fannie's still been pretty aggressive on, full term IO. We're seeing deals done at, 65, 70% leverage right now. The newer deals, the Class A deals are probably 60% levered, and then B's maybe 65, and then C's could be 70 to 80%. Right now, just because of where cap rates are. And so Fannie Mae is still, very strong contender. A lot of deals are going Fannie and Freddie right now in today's market. Non-recourse bridge, this is, spreads are really about 3.5 to 4. Most people are buying these rate caps right here at about 2 to 3%, just to keep their all-in rate around 6% or lower. And it's costing you about 3% of the loan amount for each year. And so as you go out, it's 3%, 5%, 7%, depending on how many years you're going to buy. If you're going to buy a new deal, you need about 7% of the loan amount, because essentially you're prepaying that interest, because you remember the forward curve doesn't even get down to 2% in 3 or 4 years. And so it's still quite expensive to buy these rate caps. Here's some of the closings that Old Capital had in 2023. Mostly Fannie and Freddie, because that seemed to be what most people were comfortable with, taking, whether the agency probably in that 5.5 to 6% range in order to buy some of these deals or refinance some of these deals. Why people use Old Capital really is, before the deal, before you even start in this business, sort of the education piece and, helping you through the process, introducing to different team members, and then during the deal, representing you as the buyer, whether it's touring, connecting you with vendors, and then helping you through the loan process. And then after the deal, which we're seeing a little bit more now, is making sure whether it's asset management, whether it's loan servicing, helping you through that process. And so that's why people use Old Capital. And then our upcoming event, we just finished up our pickleball event and our a couple of our bus tour events. And then, the big upcoming event that we have every year is going to be October 9th and 10th here in Dallas. So you can go to oldcapitalconference.com and register for that event. It's going to be in honor of the presidential election, we're going to have it at the Bush Library Institute near SMU here in Dallas. And so go on to oldcapitalconference.com and you can register for that event. And then, next steps. If you like the video, definitely like the video, comment, share the video, subscribe to the channel. And then if you need help with upcoming loan maturities, send me an email with sort of T12 rent roll loan agreement. And then whether you're looking at a loan term sheet or reviewing a deal, happy to take a look at those. Or if you're just getting started, send me an email, set up some time with me, and we'll go through sort of your personal financial statement and talk through any deals that you have currently or deals that you're looking at. So appreciate everybody watching, and see you next month.